Hi, still here. Welcome to our latest edition of Highlights, our key trading and active investing strategies. Exchange traded options first started trading back in 1973, but over the past decade, the popularity of options has grown in leaps and bounds. According to data compiled by the Options Industry Council, the total volume of options contracts traded in the U.S. exchanges in 1999 was only about 507 million. By the time 2007 rolled around, that number had grown to an all-time record of more than 3 billion contracts. So why the surge in popularity? Well, although they have a reputation for being risky investments that only expert traders can understand, options can be useful to the individual investor. We're going to look at some of the advantages offered by options and how candlesticks can play a role and the value that they can add to your portfolio. Options have been around for at least 30 years, and they're getting more and more attention all the time, well deserved, as I might say. There's about 4 key advantages in no particular order that options may give a trader or investor. They're going to provide increased cost efficiency. They may be less risky than equities. They have the potential to deliver higher percentage returns, and they offer a number of strategic alternatives. With advantages like these, you can see how those who have been using options for a while would be at a loss to explain options' lack of popularity in the past. So let's look at them one by one. If you need a refresher, we've got a lot more details in our options packages and webinars and DVDs in candlechartsacademy.com. Options have great leveraging power. As such, an investor can obtain an option position that will mimic a stock position almost identically, but at a huge cost savings. As an example, in order to purchase 200 shares of an $80 stock, an investor must pay out $16,000. However, if the investor were to purchase 2 $20 calls, which each contract represents 100 shares, the total outlay would only be $4,000. That's 2 contracts times 100 shares per contract times $20 as a market price. The investor would then have an additional $12,000 to use at his or her discretion. Obviously, it's not quite as simple as that. The investor has to pick the right call to purchase, a topic perhaps for another discussion, but in order to mimic the stock position properly. However, this strategy, known as stock replacement, is not only viable, but also practical and cost efficient. There are situations in which buying options is riskier than owning equities, but there are also times when options can be used to reduce risk. It really depends on how you use them. Options can be less risky for investors because they require less financial commitment than equities, and they can also be less risky due to their relative imperviousness to the potentially catastrophic effects of gap openings, windows as we know them in Japanese language. You don't need a calculator to figure out that if you spend much less money and make almost the same profit, you'll have a higher percentage return. When they pay off, that's exactly what options typically will offer to investors. The final major advantage of options is that they offer more investment alternatives. Options are a very flexible tool. While it would seem obvious that using options can be traded not only for upside but also downside direction, many don't realize that the use of options also allows the investor to trade the market's third dimension, if you will, no direction. Options allow the investor to trade not only stock movements but also the passage of time and movements in volatility. Only options offer the strategic alternatives necessary to profit in every type of market, up, down, or sideways. Let me show you a great example that covers cost efficiency, lower risk, as well as a higher potential return. Not so long ago, we put on a trade in the morning trade setup in our mycandlecharts.com site on gold. Back on the 31st, you can see that the price action came down into what we considered a support area based on some lower shadows and other price action. There was a lower shadow in the previous session on the Friday the 27th. On Monday the 31st, a long lower shadow, which looks a lot like a hammer. The upper shadow simply just declines that it be a true hammer. However, looks a lot like a hammer after several declining days, and consequently we put on a long trade for gold. looking for upper targets. You can see where the blue shaded areas above were for our targets, at least initially. Now, who's going to buy gold at $1,200, $1,210? Not many. You can actually buy options on futures, or you could also choose to do the ETF GLD at about a tenth of the cost. Let me show you. So here's GLD, and with the same premise, the pattern is about the same. The chart moves a little bit differently because it gaps has more windows than actual gold futures naturally, but you can see that long lower shadow right in the vicinity of $115, almost 116. One could have purchased call options to go long GLD at a fraction of the price of not only the cost of GLD, but also the cost, of course, of futures in gold as well. So not only did GLD cost you less than gold, but the option itself costs significantly less. Now the return was substantial as this jumped in price a couple of days later. You can see where it gapped all the way up into almost the 119 area. So an immediate $3 gain, small percentage when it comes down to the GLD, but from the standpoint of had you purchased 116 options, this is now up in the 119 area. If it was an at the money, you would have regained about 50% of that $3 gain. In other words, a $1.50 gain on a fraction of the cost. Your return on investment would have been substantial. And here it is, gold itself. So you can see the two profit targets that we had. It blew through the first one, immediately went right to our second one, and then from there, even on the following day, continued to go higher. So if one was to trail, one could have trailed an option. One could have also trailed, of course, the cost of gold or GLD in itself. But you would have treated that option very similarly as a stock replacement on GLD. So great trade. Cost was minimal, high return, low risk as well. Let me show you another one. We've been watching and viewing RIG for quite some time in the options outlook session that we do every Tuesday out of the mycandlecharts.com site as well. As you can see by the wedge-like formation, this was pinching and compressing on the right edge of your screen, undecided which direction it was going to take. So a couple things to point out. One, based on the overall pattern, my inclination was that this would go to the upside. So we were looking for the long side, but ultimately this pattern yields somewhat of indecision. Not to mention the fact that if you look at the candles on the far right edge, for the last 5 sessions yielded undecided candles, multiple doji formations. This one could be questionable. The size of the real body is greater, but you can still see upper and lower shadows that fit right in with the 2 prior sessions as well as the 2 after sessions. So a lot of indecision, a lot of confusion at a time, which makes sense at a time when it's compressing very tightly, not knowing if it's going to go up or going to go down. From an option standpoint, you could have bought calls for the long side as well as puts on the short side. And based on the next move, you would have actually still won on the trade, yet still being fairly neutral and undecided based on what the candle formations and the overall pattern were telling you. RIG blew to the upside as we had originally thought and predicted, and continued even higher in the second session. So with your long calls, you would have made substantial increase in gains based on the volatility. The volatility to the upside would have killed and crushed the put. In this case, lowered its value, raised the value of the calls, and whatever you would have lost, you would have gained still substantially and still won on the trade, yet being undecided, but recognizing a pattern of indecision with candle formations and your trusty trend lines to give you and yield you a profitable trade and in a most strategic alternative in options. So having now reviewed the primary advantages of options, it's evident why they seem to be the center of attention in financial circles today, including with us here at candlecharts.com. Be sure to check out and look at your inbox this week for emails regarding candles and options and their advantages and benefits. I truly hope you found this informative and look forward to working with you as we continue our path to better education. And may the Nison candlesticks continue to enlighten your path to greater prosperity.